What's up, everybody? It's Megan here with the Financially Free Era podcast by SLP Wealth. And today we are going to be doing a recap of some of the biggest, well, I won't say biggest, the most interesting news titles in the finance world over the past month or so, over the past 4 weeks, that I have plugged into our monthly newsletter under SLP Wealth. And I wanted to just chat about some of these news stories because I thought, one, they were interesting and they kind of lead into other financial planning topics that I think are cool to talk about. So we'll do a recap of, let's see how many I have. I think I have 9 different news titles that we can talk about today. And I'm going to start out with something pretty interesting. I'm going to start out with something called Fartcoin. No, I didn't misspeak. That is what it's called. So Fartcoin and mortgage eligibility. Let's talk about this headline. So recently, the FHFA is allowing or about to allow crypto to count towards mortgage eligibility. And so this has not been the case previously. Usually assets like cash, anything completely liquid like cash, high yield savings accounts, checking account money. That is what mortgage companies will consider when they're looking at mortgage eligibility. Maybe liquid funds too, like our brokerage accounts, because that could be liquidated, but they're not going to look at retirement funds because those are locked away for retirement, right? So the FHFA, I guess with crypto being more and more present these days, they're including, I guess, crypto in to be part of this mortgage eligibility calculation. There's a couple rules though. One is it has to be held on US regulated exchanges only. It has to convert to USD, but it doesn't have to be converted for the purchase, which is kind of interesting to me. So conversion to USD at the time is not actually required yet. I'm going to say yet because this is also something that's being fleshed out. A lot of this is not totally like written into stone yet, but this is what's been talked about so far. And there's going to be some protections against volatility, especially if they say, hey, you don't have to convert it into USD, because crypto, just like any other security, can be volatile. There can be like movement in the value of that fund or that security. And so volatility protections, some kind of range maybe that it stays within during a certain window of time, like there has to be some kind of protections. So that's in the works. Not guaranteed that that's going to be in the final like language of how this all works, but pretty interesting. So my thoughts on this, is this pretty bullish for crypto in general, or is this just a bureaucratic part, chaos, I guess you could say? Could this cause a lot of chaos? I kind of think it could, in the sense that from my experience, some folks that we've worked with do have crypto, but they don't quite understand how it works. And some cryptocurrencies are very new. So like Fartcoin, I was just talking about, that came out in 2024, and it's a meme coin. So a meme coin is, let me kind of explain based on what Google tells me. So a meme coin, according to capital.com, means its value and popularity are primarily driven by internet memes, social media trends, and community engagement, rather than having an actual like intrinsic utility or groundbreaking technology like a more traditional cryptocurrency such as Bitcoin or Ethereum. It was originated by an AI experiment called the Truth Terminal. And this was developed, Fartcoin was built on the Solana blockchain. I hope I'm pronouncing that right. Utilizing the SPL token standard. And they're known for its high transaction speeds and low fees in general. So while Fartcoin, sorry, I'm immature, keep saying it and it's just weird to say, has experienced a surge, while it's experienced a surge in popularity and price, it is essential to understand that meme coins are highly speculative and volatile in and of themselves. Their value can fluctuate very dramatically based on market trends, community interest, which a lot of that could be very short-lived, right? So before investing, and this is not a recommendation or a suggestion or anything to do anything with Fartcoin, But it is crucial in general to understand and conduct research about what you are investing in, especially crypto, especially if it all of a sudden is hot, because sometimes folks will hear about an investment or something, that's exciting and everybody's talking about in the market. And pretty much by the time you're hearing about it and it's already exciting and people have bought into it, you're a little too late to the game, right? It's going to be priced pretty high at that time. Kind of taking it back to the mortgage situation. This could be interesting because it could actually affect mortgage borrowers. And I'm not just talking about Fartcoin, but like any other like crypto position. This could help with mortgage eligibility if you are somebody who carries a lot of this in their portfolio. But I would say I'm kind of skeptical in the sense of it does seem like this is a very volatile of anything. Like this is a very volatile asset to be tying to mortgage eligibility because you could be seeing that value be cut in half or into a fourth or a 50th, overnight because something is no longer popular. And that is less common. It's not impossible, but it's less common with a more diversified portfolio, index funds, mutual funds, where we've got hundreds of stocks and bonds within it, based on company profits and company debt that you're purchasing. So I'm hesitant, to think that this is a good thing because this could be the next like 2008 mortgage crisis, 2007, 2008 mortgage crisis, where it looks like, on paper, somebody can afford a mortgage. But at the end of the day, a lot of that, like asset availability, the value has shifted very dramatically in a very short amount of time. And all of a sudden, you wouldn't be eligible if you were looked at today. So it's kind of an interesting topic. So it's, cool in theory, I guess you could say, but not something I think I would bet your down payment on or like put your down payment money in. We recommend putting down payment money, since if that's going to be like a shorter term goal, into a high yield savings account, something that's not tied to the market. So when the time comes to be putting the money down to purchase the home and to be ready for a lot of those big like upfront expenses, we have the money there. It has not changed value. It's very safe and secure, right? In a high yield savings account or an FDIC insurance protected bank account. So that was one of the newsworthy titles I put in my recent newsletters. I thought was pretty interesting to open with. Next up, let's talk about Tesla. Tesla has been tumbling. The position itself, the security, the stock of Tesla has been tumbling after Elon's America Party. So the headline was Elon Musk launches a political party. Tesla stock drops 8%. So it doesn't seem like the market is reacting well to this. And Q2, so quarter two, just wrapped up. Car deliveries were already down about 14%. There's big competitive pressure with China. So there's, a lot of things at play. There's also the tariff situation with China. So shareholders are really nervous that Musk is distracted again and not really focusing in on Tesla, but focusing on other things, other political things, and not really zoning in on his business. So what's tough here and what's actually kind of interesting. So this makes a good example of founder risk. And when we're talking about financial planning, when we're talking about investing. So founder risk is when the CEO is the brand and volatility follows that brand. And Elon Musk has had a lot of things over the past couple months, past year, that have made Tesla kind of react, like the value of Tesla kind of react to what he's doing, to what Elon Musk is doing politically, socially, personally, in his personal life, right? Everybody knows how many kids he has and what he's naming them. So market reminder here is having charisma is not corporate strategy or, being popular for a second because of XYZ on, a podcast or on social media or because he said something funny in the news. Like, it's not a corporate strategy to keep a company like moving forward, moving in the right direction. So if you're investing in companies led by very big personalities, buckle up because it's not going to be boring. It's rarely stable because, again, like founder risk, but the perception of the value of that stock or that company is closely tied to the person who's running it. So good or bad, right? It could be good, could also be very bad. And that's a lot of pressure, right, for one person. All right, next story. Buy now, pay later is now going to be hitting credit scores. So the buy now, pay later will be included in FICO credit score models soon. Well, I'll say right out the gate, I'm not a huge fan of these. So, like Afterpay, for example, there's a couple other companies that do this, but where you purchase something and in almost every payment screen online now, they give you the option to chop up the payment. They say, hey, you could pay now with your credit card or your bank account, or what if you paid 200 today? Let's say it's like a $1,000 purchase. What if you paid 200 today? Then you can pay the next 200 2 weeks from now, and the next 200 2 weeks from then. So what it does is it helps people break up a purchase into multiple payments. So the good parts about it, one is it could help credit thin borrowers. So let's say people who don't really use credit cards or don't have a lot of credit history yet, it could help credit thin borrowers build credit, right? Especially if they don't use credit cards at all. But it does risk phantom debt. And that just means, multiple small little loans that add up pretty fast. It looks like cash, but it acts like credit. This buy now, pay later situation. Because we're paying something now, but it's like credit in the sense of we're not paying it all. We still have more to pay later. And overuse can happen kind of quick before people realize it. And I've literally seen this with clients of mine. So overuse can quickly tank your score because we're overspending. We're not realizing how much we're spending. So let's do this. Let's take a little exercise for a second. And I do this sometimes because I need perspective as well. I'm not perfect. I sometimes struggle with like recency bias. So maybe take a look at your credit card statement or whatever statement from a card that you spend on regularly. Look back 30 days ago. So look at today's date, look back 30 days ago. Look at what you spent money on that day or around that time frame, right? Let's pretend it was lunch out with Sarah, your friend, and it's that brunch that you swiped your card for. And you think, wow, that feels like a long time ago. I feel like I haven't seen Sarah in a long time now. It's been a month, right? So that being a month away, and in actuality, that's not that far. And a lot of times when it comes to budgeting and cash flow planning, we're going off of month to month spending. And so that exercise just helps put into perspective that a month ago feels like a long time ago versus like within this week. You could look back at the same statement or same card that you're looking at. Look at your spending from yesterday, or let's just do like 7 days ago. That probably doesn't feel too far away, right? And so when folks are doing this Afterpay situation, they may be doing this multiple times a month to purchase things. And they're thinking in the back of their head, they're like, oh, well, I haven't done this in a while. Well, a while could have been 2 weeks ago, or 3 weeks ago, or 4 weeks ago. And so technically, yeah, you did do this pretty recently. And so those payments start adding up over time. And yeah, so overuse can really it can add up. It can really soak up your cash flow and you already have the product, right? So you purchased it, they sent it to you. You're still on the hook for the rest of those payments. So you have the product, but you're still paying for it weeks and weeks and weeks later, maybe months later, which can feel not so great. Like when you're at the end of that payment chain, like, man, when is this going to end? And it's like, well, you had the product. So like the immediate urgency of getting that thing in your hand is already taken care of. And now you're just continuing to pay for what you committed to a while ago, right? So I would say buy now, pay later. This is not a budgeting tool. It's a debt situation. It's debt with lipstick. Let's call it that. I wouldn't, if you wouldn't put it on a credit card, if you wouldn't pay full price for it today, maybe don't put it on Klarna either or on Afterpay. It's just, could it be used responsibly? Sure. For like one purchase, maybe you need to chop something up. It doesn't, maybe it doesn't have interest or something. Fine. But if you're doing this for multiple purchases over time, just be aware that it is going to add up and it can be a sneaky way to soak up a lot of cash flow that you don't even realize, happens until it happens, right? Until you start seeing it come out of your checking account. All right, next up. Next headline has to do with student loans. So the IDR repayment tracker, income driven repayment tracker, is going to be making a comeback, apparently. So the IDR forgiveness tracker, it was on studentaid.gov. That's the federal hub for all federal student loan information. For a long time, we did not have any way to know where someone stood when it came to where they were at towards their longer term forgiveness journey. Like if they were on pay, a 20-year timeline to forgiveness, we had to basically take a look at payment history to see, okay, well, we're about 7 years in based on what I can tell from your payment history. But there wasn't like a source that said, hey, this is where you're at to give you like confirmation. That changed last year. They did come out with a tracker similar to what PSLF folks have, where it shows month by month, the months that are counting towards the longer term forgiveness timeline, which was amazing. I loved it. It was great. It was super helpful. It confirmed a lot of things for folks. It corrected a lot of thinking for some folks that thought they were maybe further away or closer than they originally thought to forgiveness. So it was great. And then they took it down. They took it down when they started fighting about Save, going back and forth on what they wanted to do with different repayment plans. I suspect because, again, they didn't know what they wanted to do with different repayment plans. They were trying to, at one point, alter different repayment plans so that, showing that payment history may have been misleading if they were going to make massive changes. So it's supposed to be coming back, though. That's the big win here, is it's supposed to be coming back. So that's really positive. It does help borrowers monitor progress towards loan forgiveness. And it is especially critical for PSLF folks, but thankfully the PSLF tracker never went away. It's still live, still working. So we just need it back for our IDR forgiveness folks. And I think it is a win for transparency and planning to have this available on the website. I can't believe it wasn't available for a long time. Like you would call the servicer and they also would not know. They'd have to, take a look at your payment history with you. So it was kind of interesting. I was like, okay, well, how are you tracking this then if you don't have that information readily available? So it was a little worrisome, but that tracker came out and it really put some minds at ease. And so we use, that payment history. We plug that into our student loan calculator when we're doing our student loan plans with folks, trying to model out like when we can expect the loan forgiveness, what it's going to look like, what that potential forgiveness amount is going to be, so we can project the potential tax bomb. So it should be back soon. We'll make some kind of an announcement or note when we see it. Haven't seen it yet, but should be coming back. Next headline was some global crackdown on Finfluecers, so financial influencers. The headline was FSA leads crackdown, 3 arrests, 650 plus takedowns. So this is pretty interesting because finance on social media is Wild West, very unregulated. And not that, social media is responsible for necessarily like monitoring financial data for accuracy. It's really the people, it comes down to the people and their own personal responsibility to fact check themselves, make sure that they're telling the right information. So what's kind of interesting about this, influencers, if they don't have any kind of financial licensing or financial background, they have no requirement to do this, to monitor themselves, to kind of make sure that the information that they're talking about is factual. And what's leading to problems with this is influencers have been starting to promote, and this is not new, but have been in the past and currently promoting pretty risky financial products without a license. And so, historically, to be able to sell or solicit a financial product or a stock, a security of some kind, anything like that, you have to be licensed. You have to be a licensed professional. And so that's why you also kind of won't see a lot of licensed professionals on social media being one of these finfluencers, because our industry is heavily regulated, where we can't go online and just say generally, hey, XYZ stock, go buy it. Now's the time. Like, we can't do that, because to make advice or to give advice about a financial product, a security, we have to at least adhere to what's called the suitability standard. And that just means that that product has to be suitable enough for your personal financial circumstances to recommend it, right? But on social media, you're not talking to anybody one-on-one. You're talking to the masses when you're recording a video and you're saying, hey, this stock is amazing, blah, blah, blah. You're talking to the masses. So you cannot be, making sure that everybody who's going and following your advice, if you have thousands and thousands of views or likes on your video, you're not monitoring if they're all suitable to go and do this, like to go and purchase this or to go and start in this investment. So what happened is about 50 plus websites were removed globally. So this isn't just in the US, but globally. And, what's interesting is this is a reminder that social media is not financial advice. I think social media is great for tips, for entertainment, for a quick smile or a quick laugh, I use it for that, but it's not there for financial advice. Even like financial tips online should be checked, right? Check to make sure, is that relevant to you? Is it relevant in your area? Maybe that financial advice is not relevant in your area because it's illegal in your area, or maybe, cost-wise, like it's not the same cost-wise in your area. So that's I think a lot of people are aware of this, but sometimes it can be still easy to fall into a trap. And it's very common. Like clients of ours will come to meetings and ask, hey, I saw this on TikTok. What do you think about it? And that's great. Sure. If you saw something somewhere and you want to talk about it, ask questions about it before taking action, great. Super happy to chat through the pros and cons of whatever that is. And relate that back to you and whether or not that's an action you should take with your finances. But don't, execute and ask for forgiveness later. That's where maybe we get into some sticky, unfortunate situations. So in our world, like in the financial planning world, compliance is not optional. It is not optional. Even if your background is a beach and it's really casual, like even if it's a very casual conversation, like compliance is no joke. In the financial space, like if you're a designated financial planner of some kind, so a certified financial planning professional, a CFA, a CPA, like we are going to be taking compliance very seriously. So vet your sources. If someone's main credential is just, a lot of money, a Lamborghini, a Rolex, run. That's maybe somebody who has done well in their own finances somehow. But if they're not licensed or in the financial planning space, definitely take that advice, or don't take that advice, but take it with a grain of salt. Ask somebody that specific question, make sure that that's something that you should be doing. So that's just the cautionary tale there. All right, next headline is that the used car market is heating up again, which is pretty interesting to see. So CarMax saw its best quarter since 2021 after the tariff situation on foreign-made cars. I'm kind of interested to see how this goes over the summer too, because demand did spike for used cars as new ones got more and more pricey. And, this could be a good time to check resale value on your own car. And so that's what my husband and I are doing. We are looking, so he has a manual truck, a Toyota Tacoma. It's manual though. I can drive it, just so you know. But it's also not easy to drive. Like it's not a casual drive situation, like especially if you're in traffic, Atlanta traffic here. It's not fun to drive a manual in traffic. Oh my gosh. No, it's not fun to be a passenger in a manual car in traffic. Let me tell you that too. So we are looking at maybe getting an automatic vehicle. My vehicle is automatic. His is manual now. Looking at maybe his resale value on his truck to see like is now a good time because Toyotas in general, they hold their value pretty well. Toyota Tacomas, I think, hold very well, and it is a manual, so less people are going to want that. But the people who do want a manual, they want a manual, and they don't make a lot of them anymore. So that's what we're doing is we're checking resale value right now to see is this maybe a great time to, make a change, sell this truck and get some good resale value to roll into our next car. So, but used car prices, they may spike again temporarily. So the price of purchasing a used car may go up. So it's like, positives and negatives, right? You might be able to resell your car, your used car for quite a bit. But if you go and buy a used car as well, you might be paying premium prices too. So it's not going to be perfect. We're not quite in that perfect spot where prices are low but resale value is high, right? So it doesn't usually work that way. But the car market in general, it sometimes just is weird. So pay attention to that if you're in the market. Pay attention to the tariff situation that could cause some higher prices, some shifts in consumer behavior on like what brands you're purchasing. You could sell high and wait to buy. That's actually exactly what we're thinking about doing because my husband and I both work from home. We don't need two cars. We do live in a suburban town, so we can't technically walk to the grocery store. Not easily. It would be, a pretty hilly, long, I think it's like a 2.5 mile walk. So could we do it? Yes. Is it convenient? No. It would be an adventure. It would be like a whole ordeal. But we don't usually need to leave the house at different times for different things. If we're leaving the house, it's, going to the gym and we'll be right back or going somewhere together. So I think what we're going to do is probably sell if pricing is high right now for resales and wait to purchase, see what the market does. We have the opportunity to do that. We could get burned on that, right? Prices could go up at the end of the year and then we just have to buy at that higher rate, but we're comfortable with taking on that risk. So kind of an interesting situation right now. But yeah, if you're planning on trading or downsizing, now could be an interesting window to pay attention to for sure. Next up, the penny is out. So the US Treasury is phasing out the penny production. This is pretty crazy to me. All of us know what a penny looks like and what it feels like to find a penny head side up, right, on the ground. But it is pretty interesting because creating a penny, making a penny cost more than it's worth. It costs 2.7 cents to make one penny. And so, I think consolidating that effort, kind of taking out that loss, really just relying on bigger coins like the nickel, the dime, that can maybe help that penny situation. But there's a catch here. The nickel actually costs even more cents to produce. So a nickel, 5 cents, right, costs 13.8 cents to produce. So what is that going to mean? Well, if we start taking out the penny and not being able to use a penny in circulation, so everything's kind of rounded to the next 5 cents, so the demand for nickel goes up, there might be a demand for more production of nickels, but it costs even more to make than a penny. So it's pretty funny. So businesses will start rounding prices in this situation, right? This is government math at its finest. Just kidding. But it's almost like we're trying to solve one problem with the penny, but we're going to create another problem that's actually even more expensive with the nickel. And, will this mean that cash transactions in general just become too clunky to really survive? I think a lot of folks in general spend on their credit cards these days, but cash is not dead. Like people still use cash. So pretty interesting, but the end of the penny is the beginning of some interesting, weird pricing in general when it comes to our currency. And digital payments, I think, will continue to take over in general. So we've got, Apple Pay or credit cards, debit cards. I think that'll continue to be more and more popular. Next headline: Southwest is killing free checked bags and embraces assigned seating. I couldn't believe this when I read this. Very, I'm a very loyal Delta flyer because I'm in Atlanta. Delta is our hub here. It's almost impossible to not want to choose Delta to go anywhere because Delta always has direct flights for the most part. So Southwest is something I have not ridden very often. I think I've taken one or two Southwest flights in my life. But so Southwest used to have free bags, kind of like Delta. Delta has free bags, free checked bags if you have a Delta card, which I do. I have a Delta Amex credit card. So Southwest is no longer going to have free bags, and then they're going to be assigning seats coming late 2025, apparently. And that was always what was kind of interesting about Southwest too, is like it wasn't, all right, zone one, zone two, zone three, you can board. It was, we're boarding, and you like dart to that line to get in your space. So it's pretty interesting to see some of these big changes that made Southwest like very unique. It is a total brand shift. I think shareholders are likely happy because this might help with profitability. But loyalists, like people who love Southwest, are probably not so much happy, right? So the boarding process will definitely change. It'll be very different than what folks have been used to. It's the end of an era in this situation. And my joke in the newsletter was, because I always thought it was pretty interesting that like the companion pass was such a big thing with Southwest. It was like you get the Southwest card, you spend enough money, and it didn't seem like a lot of money either. But you spend enough money on that card and you get a free companion pass for like a year or something? What? And so in my mind, when I heard this news, I was like, went a little too hard on those companion passes. Didn't ya? And I'm being a little mean, but I always thought it was like, how do they do that? How do they afford that? That was always what was pretty interesting to me. So if you're a Southwest loyalist, I'm really sorry. Maybe time to rethink your flight strategy and your carry-on game. Delta's a great option, but I know Southwest is very much prominent in other areas, so I do feel for you. I did have a reader of our newsletter write me after I put this in the newsletter to say that he does still have a Southwest card that has some pretty good perks that are still available to like his spending needs. So there might just be higher spending limits for like being able to have free checked bags or things like that. So that's something to check out. Like if you're somebody who uses credit cards for spending, you pay them off every month, and you travel a lot, or you would like to have travel rewards as part of your picture and part of what kind of rewards you get out of a credit card, maybe check into what Southwest or travel rewards are options for your current credit cards, or maybe new credit cards that are available. That might be something that could help with some of this change. Last headline, and then I'll let you go for the weekend, is it is hurricane season. So this does mean insurance review season. The NOAA predicts above average storms this year. And unfortunately, literally, we just had a couple storms. We had a storm actually pass through Durham, where Travis Hornsby, our majority partner and owner of Student Loan Planner, lives. And unfortunately, they had some massive flooding there. We also saw some really, really bad flooding in Texas. That situation is still very much like live, and they're still searching for folks. It's really catastrophic. So, when it comes to protecting yourself, like hurricane season, when it comes to storm season or just weird weather, Georgia's been having some really weird weather, some pop-up thunderstorms every so often. Now's the time to review your homeowner's insurance coverage. Check your deductibles. That's how much you have to pay before your insurance coverage comes into effect. So you can line that up similar to what your emergency savings is. If your deductible is $3,000, you best hope you've got $3,000 in your savings account in case you're going to have to need to use it, right? So that's part of what's factored into your emergency savings. Do you have flood insurance? That could be something to consider if you're close to bodies of water, Certainly something that could be very damaging to property, auto property and home property. And you don't want to be, in knee deep water to find out if you have flood insurance or if you have certain coverages. You want to be aware of what you have access to. We did do a PNC insurance episode on the Student Loan Planner podcast some months back. Go check that out. I brought some PNC experts on the call, and we chatted about insurance, but a deeper dive into insurance and what you should be looking for. So that could be helpful. So that's it. That's it for my news updates, the kind of the interesting headlines that have happened over the past 4 weeks or so. Thanks for listening. I hope you have a lovely weekend coming up, and I will catch you on the next one.
Are you ready to unlock financial freedom faster with SLP Wealth? Get high-quality, affordable, student loan-aware financial planning and get the best deal for it anywhere that you're going to find working with your own dedicated SLP Wealth financial planner that is able to give you the best integrated advice across financial planning, investments, and tax, along with all the student loan hacks that you need and that impact all other areas of your financial planning. The deal you're going to find here is special just for podcast listeners. If you go to promo.slpwealth.com, you can sign up with a great discount off your first month. That's promo.slpwealth.com.